All right, so let's talk about the hidden potentials of dividend investing. So most people think dividend investing is boring or for retirees.
Definitely not for young folks.
Definitely not. I like how
we'll do that.
Yeah.
Some
he was
other.
like,
There's
for
no
young
growth.
folks. Yeah, he wasn't pointing at me. He was like, for the young folks. Let's talk about.
I'll do that later.
Let's talk about boring. Let's talk about Grace Groner. This is a true story. Grace Groner was a secretary years and years and years ago for Abbott Labs, and she got a bonus. And in that bonus was $180 or $180 of her bonus. I don't know what the actual bonus was. She invested in 3 shares of Abbott Labs. And that's all she did. And she did the reinvestment program. She did not take any of the dividends. And that $180 in 3 shares grew to over $7 million over the next 75 years of her life, which is insane to me. That you can take a boring theory of dividend investing and turn $180 into $7 million over a lifetime, basically. And if that's boring, I'm pretty excited about it.
Yeah.
Like that is
Sign me up twice.
I get all the time, what's the catch? I'm
yeah.
like,
Or
That's
why
a
have I
true
never
story.
heard about this?
Like
Yeah.
if you don't believe me, Google Grace Groner.
Yeah.
Her
That
name,
also says
or Grace Groner.
you invest in a good company that's going to be here a long time.
That's right.
Because I have my whole nest egg in 3 shares of, or plus the dividends reinvested of
Well,
Abbott.
we're gonna address that right there
all right.
later in the show. But I do want to talk about some of the things that most people wouldn't necessarily understand, but they might have been a catchword, like the DRIP, Dividend Reinvestment Program. Most people are like, yeah, I know what that is, but do you really understand it? So let's talk about that. So a DRIP reinvestment program is very, very simple. It's the Grace Groner. I'm going to invest in these stocks, this stock or a bunch of different stocks, and as they pay dividend, I'm just going to allow them to put that money right back into the stock. There are some potential dangers of doing that, depending if the company's, going to go out of business. Is really the only one.
You're right. Yeah.
Outside of going out of business, if the stock's good enough to buy and hold, it's good enough to reinvest. Okay? Yeah. There's a lot into that statement, but we're just going to leave it where it is. Okay, but I want to give up 2 examples. Okay, I want to talk about Coke and Procter Gamble. So I went on the internet and I was like, hey, can we go back in time and say, let's just, when I did my research, it picked 1984. Not really sure why, because I asked chat, I went to Google and I was like doing some research and I was like, hey, I want to invest in these 2 companies, been around for a long time, okay?
40 years, yeah.
Strong history. And I want you to start with $10,000. So put $10,000 into the stock and let it go. Don't put another dime and just reinvest the dividend. And I didn't care about the value. So in purposes of this illustration, all I care about is the income it's going to produce off of one $10,000 investment. I have no idea what the value of the stock is. And in all of our notes, you can look through. You won't even see the value because I don't even care about it. All I care about is how much is it going to pay in dividends a year today. So we invested $10,000 into Coca-Cola. The annual dividend right now in 2024, 40 years later, is $29,116.
3 times your initial.
3 times your initial investment. You're making a year in dividend, which is insane. And by the way, I did these stocks at random. I literally, when I was doing before I was like, let me just pick KO and PG. And I probably could have done some manipulation to see which ones were really good.
Yeah,
didn't even do it.
Yeah,
kind of blown away at the Procter and Gamble.
Procter and Gamble looks pretty good.
That one's a little bit better than Coke.
Yeah.
So and believe it or not, when I didn't believe it, so I was like, "There's no way this number's right." So I went back and had chat double check and triple check his numbers. And when they came back, they actually started with $5,000, not 10, because the research that they found started with 5, not 10. So this is half the investment. So instead of $10,000 in Coca-Cola turned into $29,116, not in value, in 1 year's dividend in 2024. Procter & Gamble started with a $5,000 investment, You ended with, and I didn't know the starting shares, but you ended with 31,197 shares.
Gee.
And the dividend is almost $4 right now if you go Google it. That means it's paying just this year $121,979 in dividends in 1 year. $5,000
Wow.
is $122,000 of dividend income 40 years later. That is boring.
That is.
Why in the world would anybody want to do that when you
Wish-
could
wish
buy
that could've
low
been my
and sell
birth gift.
high?
And stress out and not sleep. And
Yeah, and watch
all-
the market every
yeah,
day,
every
and
day,
day
listening to
trade.
the talking
I
heads
mean,
and
why
all the
would you
stuff.
want to do all that exciting
Oh.
stuff when you can just, be boring and turn $5,000 into 122,000 in one
Every year.
Every year, yeah.
No, and growing.
And
And growing.
Right.
Yeah.
Keep counting.
I mean, if that's boring, come on.
It would also be interesting to see over that 40-year period what the cumulative payout of dividend has been over that 40
It
years as
is
well.
millions
Yeah,
of dollars.
like that would
Yeah,
be
that's-
wild. That it's
Why
being
didn't you tell me to
reinvested.
invest in this? 1984.
I wasn't alive.
I mean, George Orwell wrote all that.
Barely.
Infant
You
being
were
thought
like,
about.
I was
Zero-
born
0
in-
years old?
yes, as my kids like to say, I was a zero baby.
It does make you want to run home and tell your kids though,
Yeah.
because my kids are like, oh, I don't like. There's an example, and that's
Yep.
about what a kid has, right? Like as they go and do their jobs, and
Well, my
that's
my
an
oldest,
example, a real life example. not
he's
just
got
me.
dividend investing or dividend stocks in his portfolio, and he's been investing for several years now, for three years. And he's like, Dad, he's like, they don't. He's like, when I was in my finance class and we were doing portfolios, he's like, we came in like middle, we're average. And he's like, I thought you were good at this. And I'm like, well, if you take a drip and you couple it with time,
Right.
you got a whole lot
Oh,
of
yeah.
value.
Yeah, it's awesome.
And I was
It's
like, Bud,
rocket
you're
fuel.
looking at one segment. And the thing that the day traders and the buy low, sell high, the excitement, the one thing that we haven't really talked about here is that there's not a whole lot of strategy going in. Now, there's a lot of thought in
Emotion.
what companies to
And-
buy,
Well, and discipline.
but the strategy is quality and time.
Yep.
And what you get here with that formula is a whole lot. Now, it's not easy to pick the right ones. And for my son, I'm like, you're looking at like a 3-month period in your finance class.
It's
for one
really
semester.
tough to do
Right.
as a class project.
Right.
For you to be
Yeah.
like, I'm going to go
Well, they
dividends.
compete. we did.
Yeah.
And even with dividend in a 3-month period, we still came in pretty well.
Right.
And actually, the gap between the winner and where my son wasn't very much. It was
Yeah.
like 3%. The winners picked flyers. They all picked stocks on Reddit.
Yeah.
They went to Reddit. That's these
Who's
students.
pumping?
Yeah,
Who's
that's right.
pumping stocks
Who's
again?
short selling here?
Yeah, and the winners had never even heard of the stocks that they were buying.
Right.
And they were depending on Reddit.
Yeah.
Okay?
Half those kids probably don't even know what GameStop
And
is.
if they did the competition the next semester,
It'd be totally
it would be totally
Oh,
different.
yeah. Over.
And the winners would be losers, and Evan would be right in the middle of the pack. And then over time, Evan would go straight to the top.
Yep.
Because he would have just been boring because he's listening to dad.
Yep.
And we don't try to run up the value. We
Right.
try to compound the income.
That's right. But again, just because we call it a dividend stock doesn't mean it's
not gonna
value's
grow.
not going to grow. Exactly.
Right.
It's gonna
Yeah.
grow.
That is another misconception.
We have absolutely crushed the market in the last quarter.
Yep.
The market crushed us the first 2 quarters of the year. The last quarter, it hasn't even been close. We have actually gained more in the last quarter, almost than what the market did the whole year.
Right. Yeah. We're basically even.
Yeah, which is insane.
And it is more consistent. Like it's easier to do once you understand it because it doesn't have these.
Yeah.
It tends
Crazy
to be more.
volatility.
Yeah.
So another thing we want to talk about is aristocrat versus high yield. Okay, so what is an aristocrat stock?
A stock that's been paying a dividend for more than
Forever.
25 years.
Yeah, long time.
Yep.
Forever.
Yeah.
Are there a lot of aristocrat stocks out there?
No. But once they get it, they fight for it.
Yeah, they try to keep it.
Yeah.
Because you'll see some companies, they're like, we
The pay
increased,
penny.
yeah, we increased it by a penny.
Just so they can stay there.
Yeah.
They want it.
Yep.
Yes.
So what is the high yield trap? What is that?
Well, that's what you want, don't you? I want this stock that pays 15% yield.
They might
Yeah.
pay it that 1 year.
Back
but
to
that could be
Evan's
a little bit
class.
dangerous. Yes.
Probably won't last.
Why is it 15%? Well, it's dropped 3 times. The value
Now
dropped.
we do a really good job empowering our clients. where we're like, we want you to know this, we want you to understand it. You know, here's our philosophy, here's our process. We don't necessarily get into how we pick stocks all the time. We're not against the conversation, but we just don't talk about that much. And then from time to time, because we do such a good job empowering our clients, we'll get emails saying, well, hey, there's this stock is paying 12%, or there's this stock. Why don't you have that in the portfolio? That's considerably higher than what our yield is. And then I'll just do a quick little search on it, because most of the time I never heard of it. And then you find out so much of what we're about to go over, you know, of why it never shows up on our radar.
Yeah.
You know, because why would a stock with a 12% or 10% or 8%, which is higher than our current yield, not show up? Well, there's so many reasons for that stock being that way. You know, because the stock probably just lost 50% of its value or 80% of its value. Or the yield's like
until
80
they decide
cents.
to cut it. Because if they're suffering,
because they
then
can't afford it. Yeah.
Yep.
So a high yield is attraction. Shiny.
Yep.
You know, we know all kinds of things about chasing what's attractive, you know, and how bad that can be. You know, understanding the stability of the dividend is probably a whole nother story. When you see a stock that has a high yield, my advice would be, well, go check out the history.
Yes.
Yeah.
You know, let's go see what the history of the dividend is.
Right.
If it's been paying 25 years, it ain't going to be 10%.
No.
You know,
Not unless there's some crazy outlandish thing that's happening.
correct.
Yeah, like when COVID happened, almost all of these companies,
Oh, it
their
was
yields
fun.
skyrocketed.
It was like a kid in a candy store.
Yeah.
I'll
But we
never
knew.
forget that May. We were looking at the portfolio and we're like, okay, it was the hardest trade of my career because I mean the bottom fell out of the market, and I'm like, now's a great time to rebalance.
Yes.
You know, and we're looking and we're like, oh my gosh. I mean, the average yield was like 8%.
I mean, I just remember Exxon being at like 10.1
it
at one
was
point, and I
nuts.
was like, oh.
I mean, we gained years.
Yes.
Because of our portfolio. I mean, the market did a V. We did more of a U, and it was the best thing that could have ever happened to our clients because they got quality stocks at bottom basement prices for months, and quarters and quarters.
Especially those that were doing what we already talked about, the drip. They had that reinvestment going on. They're just
was
slowly
awesome.
accumulating more and more shares.
Doing reviews with people pre-COVID versus people who started after COVID.
Yeah.
It's a big difference.
Yeah.
So Charlie had
The
mentioned
example because it'll come again.
dividend cuts.
Hopefully
That's
not
another
coming
really, really important thing that most people don't think of. Now, they'll ask about when they're first understanding a dividend stock or like, you want me to buy what? And they're like, well, can't they just cut their dividend? Absolutely. Anybody can do that almost at any time, not always. They typically will tell you, and then it's like, well, it's coming in 6 months or whatever it is. Not very often does it happen overnight, but it can. The reality is this is a big danger and a reality of a high yield. When the yield is that high, which means
if you're just looking at that number,
if you're just looking at that number,
that could be a real danger.
The high yield trap, in my opinion, is probably the biggest danger for somebody who's just learning about dividend stocks.
Right.
You know, like, well, I'm just going to go buy the high yield ones.
You better pay close attention.
We could probably generate a portfolio paying 10 to 15%, but
we could
how
do that
dangerous
easily.
would
And
that
how
be?
long is that going to be
Yeah.
there?
Sustainability.
And the crazy thing is, the logic says go buy it because that means the stock's bottomed out, the yield's high. That's two birds with one stone. I'm going to buy
lock
a
in.
high yield, and I'm
I'll
going to
get
get
the-
a bottom basement price, and then we just ride it back up. Well, I would love. I should actually do some research on that. I should have.
What's the reason?
And see what percent of those stocks actually rebound without cutting their dividend.
And you got to look at the debt load and a lot of things that these companies are carrying.
But
whether
even
they're in a debt
just
spiral or
ignoring
what.
all that,
Yeah.
what percentage comes back? And I bet you it's tiny.
It can't be very
Well,
many.
no.
That would be interesting.
2020, when COVID hit, that was a great opportunity to see when good companies went down, didn't cut their dividend, and then they came right back
And
up.
2020, in my opinion, was the type of situation where it's the perfect storm because stock prices went down, but it wasn't connected to a company decision. And that's really what you want to, you know.
The whole ocean retracted.
Here's
the
a
world
good-
shut down.
Yeah.
but the world's gonna come back. And
But this is a
right.
good tip for dividend investing. If a stock goes down that's paying a strong dividend, but it's market related or industry related or unrelated to what their business practices are doing, that's a good buy. Because, hey, this stock went down 25% because the market went down, or 40% because the market went down, or there was a governmental shift or a new law or whatever, and it affected the industry, but the company's still super profitable, tons of cash, blah, 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 payout
Totally
ratios in
short-term.
line. And then all of a sudden you're like, that's a steal.
Yep.
Because that's going to come back, because
Right.
all this other stuff's going to sort itself out. And when it does, I'm going to be able to buy 40% more, 25% more on sale, where some people are like, everybody just blew up that stock, sell, sell, sell. And you're like, what?
Right.
That's a strong buy.
A lot of times in a sector, if one company goes belly up or whatever, the rest of the companies in that sector get hit for a short period of time.
For a short
But
period.
they're coming back.
They're coming back.
They're
So let's
coming
talk
back.
about the total return approach. What is that about? I hear that often.
Well, we talked about it just a minute ago. Not only will dividends build up your portfolio, but the growth.
Yep.
Growth.
You want a company that's going to pay that dividend, increase it, and you expect growth in the future for that company too.
Now, for a company like ours that absolutely loves dividend investing, okay, this is like the most difficult thing to manage, because you're like, okay, where are the strong buys price, and where are the strong buys on dividend? Why is the dividend secure, strong, predictable? And where's the capital appreciation? And I'll never forget a client, we were talking about this, and I'm like, my last book, I want to plan for income and hope for growth. And he's like, well, I want them both. And he was just dead serious. And I was like, oh, okay. Well, I do too.
Right.
But you got to specialize in one, so,
What's your retirement one?
but the reality is we focus primarily on the dividend strength, because we say if the income is there, the growth will follow.
And that's the thing too, is you hear the little catchphrase, let your winners run. And that's what we do sometimes when the value of a company keeps going up and the dividend percentage shrinks. But you say, well, if this is going to grow 10%, we feel good about it this year. It takes a lot of 1.5% dividends to catch up with that.
Yeah.
And then when we rebalance, it sells some of that and buys the bigger dividend yields.
Yeah. It makes me think of Nucor, right? Like they're just in a strong sector that's really growing.
Yeah. I mean, the fun part about this is it is exciting, to pick good, strong stocks for multiple reasons, and there's so many different things that you can dig into on a dividend stock, where, I mean, there's just the same on a growth stock, but on the dividend side, you have all the same factors that you would look at on a growth, but then you have the whole nother factor set for on the dividend side.
They're paying you the whole time.
Yeah.
Giving you
Well,
income.
not necessarily the benefit, but the research that what makes the dividend company strong. So, because if you're going to look at growth, you want to look at fundamentals, you want to look at cash, debt, you want to look at where they're investing their money. You have basically all of that apply to both a growth stock and a dividend stock. But the dividend, you have a whole nother set of information that you have to dig into on the dividend, their cash flow, their payout ratio, like a lot of things, their debt load, what obligations do they have? I mean, there's so much stuff that you would want to look at that's on top of what you need to look at from where's the company stock price going to go. Well, with the dividend, I feel like the more research, the better position that you're in to make a good quality decision, because on the growth side, there's not that obligation of how to manage that extra cash. So the growth stocks actually, in my opinion, harder to predict, because all of their cash goes into the performance of the stock, where the dividend side, they have an obligation to pay that dividend.
There's added value.
And added value.
Because you think about growth stock, and I believe the market is very emotional. You tie that with an algorithm, and it can just jump everywhere. And so growth stocks are very much subject to those emotions and what algorithms are buying and selling.
And they're putting more emphasis on where they put their cash, which makes it highly more volatile, because you don't when a company spends money to invest in something like Facebook, they're putting billions and billions and billions into something that hasn't produced any money.
Yeah, the whole meta.
The whole meta. And they're just continuing to do it. And then the investors going, well, I hope it works.
I hope, yeah.
Because it's been years now and you're not making any money. So that makes the stock potentially much more volatile, or an Apple or
Netflix. Like they just keep pouring it back into content, which is great. Like that's why you subscribe. But at some point, how much content can you have?
It's funny with some of the growth, like cybersecurity and things. If they see, they estimate, we're going to improve our revenue 30%. If the investors, the big money, thought, well, you should have improved 50%, that stock will go down. They had a great year over year, but yet I don't know if it's reasonable or not.
That's
goes
one of
down.
the craziest things to me, that they'll say, hey, we think that this company is going to have growth of, 30 cents per share, and they hit it at 29.5. Oh, yeah. They didn't hit it.
Sorry. Yeah.
Tanks. And it's like, they still made 29.5 per share.
They still made $20 billion
that
quarter.
I mean, that was NVIDIA, just their last quarter.
Yeah.
They were off, I think, a couple $100 million, but they profited $30 billion for the quarter.
Which, considering their impact on AI, is not much money.
No.
I mean, they're basically running all tech for the future. I mean, AI push is huge, and they only made $30 billion. And then you look into Amazon, they just sell products, and they're making $200 billion in a quarter. What?
They're selling product that other people make.
Yeah,
They're just
they're a facilitator. Yeah.
So let's switch course and talk about sector diversification. This is a buzzword.
Diversify.
Yeah, let's diversify. Not only just on industry. Let's do sector. I mean, let's look across the
globally. We got to be international and here domestic.
Are there any downfalls to this?
You might be diluting your earnings.
Right.
Yes. Yeah, if you get too diversified, you
especially
don't get to
inversely diversified.
Cancel it out.
This is a negative one or whatever. So I earn $100 on this one. I lose $100 on this one. What a great year!
If your philosophy, one of your main guiding principles is to be sector diversified, you're shooting yourself in the foot before you get out of the gate.
Because in a sense, that's not even diversified. Everything's in the U.S. market right there.
Well, regardless of U.S. domestic or domestic international, I think if your ruling principle is I have to have a stock in these sectors, you're shooting yourself, because what if that sector, because of what's going on, doesn't even have a stock that qualifies on all your other things, but you have to buy one just because it's diversified?
Because they told you
what
to do
are you
that.
doing?
Yeah.
Right.
Because what Warren Buffett says, what?
I was going to say, Warren Buffett would say no. Yeah.
What's the quote?
He says diversification is for people that don't know what they're doing.
Yeah.
Correct. So when it comes to sector diversification, in and of itself, it's not wrong.
Right.
It's just not necessarily required.
And it could be limiting.
It could be limiting. Like you look at our portfolios and you go, well, why are you so overweighted in this sector, this sector, this sector? Because they got some strong players. We could have an entire portfolio based on some of these things. Now, we won't do that.
Right.
But we're not. There are times where we're like, man, we can't add another one of those stocks, because they're so attractive, and they're strong and whatever. But, where sector diversification comes in is I would think of it through this lens. I'm not requiring myself to be a part of everyone, but I don't want to require myself or I want to limit myself how much I have of one sector.
Right.
I think if we think through the lens of where can I hurt myself by not being diversified enough, that's a good priority or good perspective. Having every sector is not.
No, because we're looking at good companies.
Yes.
Right.
Doesn't necessarily matter what sector they're in.
No. I mean,
Good
sometimes,
dividend paying,
depending on the environment, you want to be overweighted in a certain sector.
Right.
Like where people look at, you're wherever, at a golf club or, or wherever, and you're having a conversation and then somebody's like, oh, I made X. They're just talking about one stock in one sector.
Yeah. Right.
Yeah. What'd you lose on the other 29?
Right.
They're not talking about their own entire portfolio. Investors tend to brag about the success hits, which is typically one position, and we're looking at an entire portfolio, and our desire, our advice would be, don't make decisions based on equality. We have to be spread across because that's going to be the safest thing. S&P 500.
Is that
diversified? No,
that's
that's
so heavily
nothing to do with
concentrated.
sectors.
500
The
best
NASDAQ.
companies. Yeah.
The NASDAQ's one industry.
Yeah, they all
Yeah,
tend
it's all
to.
tech.
Yeah.
So like the benchmarks literally that run our industry don't even take into consideration sector diversification. Yet when you talk about the financial industry or you talk
That's all they
about
follow.
the laws that govern our industry,
Yep.
they're all about contradiction to what our benchmarks are. So if it's good for the law, why wouldn't we not have benchmarks that are equally diversified?
That actually is a really. I've never thought about that, but that's exactly right.
It's stupidity.
That is so.
You always like to use the analogy whenever you're creating our portfolios for our clients that you're creating a sports team.
Oh, yes.
Well, you don't have as many kickers and punters as you do wide receivers, or
Well,
linemen or defensive players.
Well,
Like
technically,
it's all
like
kind of
the punters and kickers. One of the backups to the backup would always be like a lineman or a running back or some guy that could kick in college or whatever. They had
a lot of times it's like the quarterback or a wide receiver. I mean, I remember one of the backup quarterbacks for the Steelers a long time ago was Randall L.
Yeah,
who was their slot receiver. They just didn't carry anyone,
and he would play.
He played. Yes.
Yeah, even when he wasn't. Like they would randomly put him at quarterback.
Yes. So that's, I mean, even bringing that analogy full circle, like that's when you build teams.
Right.
There's diversification, but it's not equally weighted amongst all sectors of your team.
All right, we need to move on because I'm hot under the collar about this right now.
Yeah.
All right, so let's talk about payout ratios. So payout ratio is basically the percentage of the company's earnings that's paid in the form of a dividend. So a payout ratio, a comfortable range would be low percentages. Even a negative number, which would be impossible.
No such thing. Let us know.
But a high payout ratio isn't necessarily a bad thing if you know what it means. So a comfortable would be like 30 to 50%. 20% would be like ideal, but those are really hard to find. So that means of all the earnings, this percentage is related to its dividend. Its dividend. Yep. However, if you see like a super high yield or super high payout, like 230%. Like how could they pay their dividend? Well, you got to look at their cash, and you got to understand why that's that way. And we've had situations
we've
where
had some over 100. Just depends on the type business it is.
Well, but then you also have situations where one company absorbs another.
Yeah,
and they have all these new shares, and then all of a sudden that payout ratio went from 30% to 130% in one quarter, and you're like, what just happened? Well, there's a legitimate reason behind that. Yeah. So a payout ratio is really awesome to understand and know. It's really important. There are some dangers of not understanding what that ratio means, and we just gave a couple examples of that. But a high payout ratio isn't necessarily a red flag, because
it should be a red flag, but you just find out what's behind it.
Yeah, not necessarily. It's a reason to research.
Yes,
correct.
Right.
It's a reason to understand why that payout ratio is high. Another thing that's really important to understand, which isn't in the materials that we're going to talk about today, is the cash on hand of a company as it relates to its payout ratio. Because a lot of times a company will float its dividend through its cash or a portion of its cash because it understands it's going through a season. They have
a cyclical,
or they understand, hey, we're doing these things that are forecasted to do X, Y, Z. It'll take our payout ratio down. You have to monitor that. But if you look at the cash on hand of our portfolios, it's monstrous. I mean, we're talking in two major portfolios. We have in one $650 billion in current cash on hand and trillions in asset balances on their books. And the other portfolio, 1.3 trillion sitting in cash in a single portfolio. 1.3 trillion. And then they have 4.1 trillion in asset balances on their balance sheet. So huge amounts of cash. So when we see a high payout ratio, or when we see a concern, I always want to immediately go, okay, how many quarters is this company good on? It could be 6 years.
Right.
Mm.
7 years where a company could literally not, and that's not operating the company because revenue operates the company. This is just excess, like
cash reserves.
Yeah.
This is what they use to invest in.
Billions.
Yes.
In some cases, trillions, of dollars, which is just insane. Yeah. All right. So let's close this thing down. What are some takeaways? We've thrown out quite a bit of things to educate today. What are some takeaways?
It is somewhat the slow and steady, but just because it's a dividend stock doesn't mean that it can't be exciting.
Oh, yeah.
I was going to say balance, and I was also going to say the consistency of staying in and letting the time do its thing, and the drip. The time, the compounding, the drip, it does. Like it, and it might look like it's going slow sometimes, especially at the beginning. And then and it's one situation that was really challenging. Then you come out of it and it's like, but they've almost got to go through it. But yeah, just stick with it. Don't let emotions get the best of you because it's going slow now. It's doing some stuff if you got the right ones in there.
Yeah. We didn't really even bring it up on how important it can be to people in retirement.
Oh my gosh.
Where here's an income stream and you don't have to sell the underlying stocks behind it. You just take the dividend income month after month. Don't have to worry about what the market's doing. 2020 won't scare you, when your portfolio value drops incredibly.
Well,
you don't have
it'll
to sell
probably scare you, but you
Yeah.
don't have to do anything about it.
Well, I'm hoping not.
Well, the deeper they do get into retirement, I notice what CB's saying. They are less and less, initially first year. So Nick, you're sure? I'm like, well, it's pretty stinking predictable, right? Yeah. Past performance doesn't indicate future results, but I can show you clients that through COVID. I mean, that was the favorite example. You had like 5 clients retire
in January.
That, yes. And the biggest one was impacted by 5%, I believe. 5% on just their dividends.
Our entire portfolio dividend in that year was only volatile of 4%.
4%.
And on the income side, our portfolio volatile went down 40%. So you have a value of a 40% swing, but where it hit our clients the least was their income, their bank account. Mm-hmm. So the money that they were living on month to month only fluctuated 4%. Right. Most of our clients didn't even notice.
Well, and a lot of them said, I couldn't go out to dinner anyway. That extra 4%.
That's why they didn't notice it. They weren't spending money.
That's exactly what they said. I said, explaining that example, and they're like, well, that works for me because I wasn't going out to dinner anyway, and that's where that 4% went.
Awesome.
That is a good point. That a company could cut its dividend, but if we've got 30 plus companies in there, that's a minor percentage of the overall dividend.
That one guy might not be hitting a home run, but that bunter might come up and find a way to get on first. Yeah. It's a team thing.
So my last thing, we started this whole discussion based on the fact that dividend stocks are boring. Yeah. If you look through history and you do a search online for value investing versus growth investing, value investing is historically labeled as boring, old, outdated philosophy. And growth investing with all structures and strategies, and it's super exciting and you can make so much money. And you compete these head to head. Value investing outperforms growth by over 4% a year over time. So and this is why we're such big fans, because not only does it perform on the growth side over time, may not win in a given year, but over time it has won by more than 4% a year. Not over time it beats it by 4. It's 4% an average of outperforming it a year. You also get that income stream. And that income stream and the drip is why it outperforms. Because if you start with growth and you have 10,000 shares, I don't care how long you hold it, you're going to sell 10,000 shares. With a dividend, you might start with 10,000 shares. You might end up with 100,000 shares. And you might have sold 50,000 of them along the way. And it's just house money at this point.
Yep.
So, and I've had so many of those discussions with clients over the time, like, hey, all the money and value and income that you have in this one position isn't even your money anymore. We sold your money years ago. This is excess money, and we've used all of that money to buy more and more. There might be 3 positions in your portfolio that you didn't even pay for.
Right.
Mm-hmm. And it's driving you income.
Well, the 2 that I would also say that people bring up to me is health. They used to stress so much, and now they actually can kind of sleep at night. The same people who say it only affected me a couple dinners out, right, that quarter. And the other thing is legacy. When you have to your point, go and sell that growth stuff to get the money that you need, that legacy of what you're going to leave, that's really
awesome.
Yeah, leaving the shares instead of just the value that you're going to spend down.
And you don't have to sell principal.
You don't.
That's why so many of our clients rested easy, and have that peace of mind. So shutting this down, if you got any questions, you want to become a better dividend investor, you could always reach out to us. That we're not our way or the highway. if you want to learn and do things yourself, we are wide open to doing that and educating you. We'd love to help. This has been good. I love when we talk dividends.
Yeah.
We all light up.
Really?
We talk different things. We're all like, yeah, it was a good show. When we talk dividends, we're all like, woo,
How
let's
boring.
go.
Yeah. So boring.
dividends.
So
So boring.
that was nice tie, CB.
Thanks for watching.